Right. Well, we're just going to talk about how to average into trades today. So something that I've done in my career for a long time. As a trader, you start with small size and you build into positions to try and negate some of the volatility that we're seeing in the markets right now, and just to kind of get areas of value, price areas of value rather than individual prices. Is just a good way to again to kind of get rid of some of the volatility and to kind of slide into the markets at slightly better areas. So before I start, as always, the risk warning: remember that spread betting and CFD trading carry high risk of capital, short-term losses that exceed your initial deposit. It might suit for everyone, so please ensure you fully understand the risks involved. The information and comments provided here under no circumstances are an offer solicitation to invest. Nothing here to constitute investment advice. The information provided is accurate data is produced. Education only. Content of the webinar is personal opinion of the moderator, not intrade.com. The content does not constitute financial investment or tax advice. Intrade.com is not accept any ability for the content consumed during this session. So what is averaging? Well, averaging is building a position into the market over a number of prices. So you can positively and negatively average. So the difference is if you're adding to a position that's going against you, if you're going offside, then you are negatively averaging. So again, if you're buying the market and it goes down, you buy more at a lower price to average into a better lower position, expecting the market to go up. If you are positively averaging, then you're generally onside. So the market's going in your favor and you add more size to a winning position, or a position that's in profit at that time. So again, it's not the same as if you're in double trouble. I mean, that's just gambling. What we're trying to do is look at the markets in a certain way and think, where are we going to find the best value? Okay, well, I'm going to buy maybe 10 lots in £2 or £10 a point, but in £2 increments, building into a position over 5-10 prices, rather than just buy one specific product or one specific price with a stop. So why average? Well, I mean, again, if you probably do a bit of self-talk and you ask yourself some questions, you get stopped out of a lot of trades. Do you enter trade several times before they actually go onside and in your favour? And do you hesitate, putting on them good trades because you're a little bit nervous? Well, if you answer to yes, then to these things, and really one of two things is happening. Your trade size is too big for your strategy, or you're certainly over-trading. And these are common in the majority of traders. So what we're trying to figure out is if you're having problems getting in to trades, having problem making money from trading, then generally, some of the problems can be helped or certainly addressed with an averaging strategy. So the market's going to move 80% of the time, technically 20% of the time, fundamentally. That's just how markets move. So again, if you see some big fundamental news like we saw today, for instance, interest rates were cut in the UK to historic lows at a quarter of 1%, and that sent the pound tumbling because you get less people demanding the pound, you get less investors craving the pound because you get less of a return, and when interest rates goes down, the base currency goes down. When interest rates go up, the base currency goes up. It's as simple as that. So if you wanted to stay short the pound versus the dollar, cable, for instance, then you could sell a number of prices higher up the range, expecting that fundamental news to send the market lower in a technical way to find support. And that's, again, what happened today. So why markets move? Well, I mean, you have to think about people that you're trading against. So there's banks, hedge funds, black boxes, institutions, teams of traders. There's people looking out, for every conceivable edge in the market. There is nothing that isn't known. That's how markets function. Markets find value because all the relevant information is known, and there is no kind of secret edge. There isn't, something that people don't know. So again, what you're trying to do is not get emotionally attached to certain positions. You're not trying to, feel bullied by the markets. What you're trying to do is just figure out when the market's high, when the market's low, and then use a strategy. And again, using the ability to buy prices in certain areas to, again, let the market do what it needs to do. As I said, the information today that came out of the Bank of England, cutting interest rates, was always going to send the pound down for all the reasons I've just mentioned. So you don't want to be squeezed out of position because the pound actually rallied a little bit on the upside and then spent the rest of the day selling off. So what you're trying to do is let the market go against you, go higher, and then you sell smaller amounts into positions going up, and as the market hits a natural level of resistance and the market is squeezed up sufficiently, then whatever happens, what we all know is going to happen then happens, and you're still in that position. So again, it's a way of dealing with the volatility and also dealing with the way of markets introducing fear and greed. So we all know that the pound should go down, but if it goes up very quickly for a short period of time, people can get squeezed out. So again, it's a way of dealing with the inevitability of market movement. So I mean, we're looking for a balance between the technicals and fundamentals. We were looking for key data and speakers. So again, key data is things like the non-farm payroll and obviously the interest rate decision. So what we're then looking to do is the markets to move in a technical way, so to break support or to kind of find resistance, etc., etc. And that again is what we're always trying to do. That knowing that no matter what the news is, it is going to move markets still in a technical manner, because 80% of the time people are looking for indicators, oscillators, areas of where the market can stop moving in particular directions. So, I mean, we're looking back to the kind of fundamental side. This is an old presentation now, but we're generally looking for Ben Bernanke to talk about delivering on rates, and that's now Janet Yellen. And although the US have said that they wanted to hike 4 times this year, it doesn't look likely. I mean, there might be no hikes at all. There might even be a cut. So we'll have to see what Janet Yellen says in response to the UK moving on their interest rate. So really, what happens in the UK shouldn't really affect the US, but I think we have to really understand this new norm, this normalization of getting interest rates back to a reasonable level. Just can't happen right now. People are massively indebted. People are servicing huge amounts of debt, and that's just the world we've created. So with each quarter point, the interest rates go up, people get poorer, and that's just the lowest common denominator. So realistically, the new norm might be very, very low interest rates for the foreseeable future, and that's it's not necessarily a bad thing, not necessarily a good thing. Things move in cycles, and the whole point is if you're buying a house at 0.25% rates right now in the UK, sometime in the next 10 years, rates will go up. So you're going to have to be paying more. If the house price hasn't appreciated, then, you're going to be in trouble. But I don't know. What do I know? What does anybody really know? So again, what we're looking for is, to look at fundamental news hitting the markets and trade it in a technical way. So you can sell into, bad piece of news, or you can buy the bottom. So, you get to see very small candles when fundamental news comes in. You see the markets really react. So this, again, is an example, this could be, a perfect example of the pound. So when the pound, kind of gets the news that the interest rates have, as expected, been cut, then these candles increase to the downside. Okay, and we sell down, and that's again we're looking for these areas of support for the market to either bounce back and liquidate our short positions, or bounce back for a for a short buy. So again, looking at the markets, when it releases it, you're generally going to see news happen, and then your markets move in like Fibonacci, and again it's markets will move in a predictable way. You get that initial spike, get the market then pulling back, for some profit taking, generally to the 50%, and then a continuation when the market goes on to make a new high. So again, what you're trying to do is be involved in the news early as you can. And again, that could mean that you start to average positions down here. It doesn't mean you can't then buy some more as the market dips back down, and then continue into these new highs that are made. So it's not really about being right. It's about being right at the right time. You're going to get more than one bite of the cherry of any big news. So you'll see an initial spike, a pullback, and a continuation. So a fundamental average, again, is what you're looking for is these break and bounce levels, areas where the market, has told you it found, support and resistance in the past. So this is low down in the fib. So you might have missed all this initial spike here, but as the market then comes back down to the 61.8 fib and the 50%, you can start buying in these areas, here. And then, what you can then do is average into these positions. And as the market then goes back up over a period of time, you've averaged into a low position. Okay, and taking advantage of that bounce. So it doesn't have to be fastest finger first. It doesn't have to be that you too aggressively trade. What you're looking for is the market to move in a predictable manner. So again, looking at the past to predict the future. So again, we're looking for the initial move, and you can look on the first 1 minute, 3 minute, 5 minute candle, and you just look for the high and the low to be made. So once you've made the high and the low, the market 80% of the time will retrace to 50%. So again, if you can buy in the levels around here, that's great. Actually, it doesn't bounce quite as low as the 50%. So what you're really doing is averaging to all these lower positions here. and then letting the market then go back up. And you don't have to necessarily look for it to make new highs. What you're just looking to do is understand what's happened in the past. So what's happened in the past, the market went from the low to the high, came back to the 50% near enough. Okay, that acted as a support. So what we're then doing is buying on this upper level, it's 38.2, and every time the market goes up, we get out. So it's buying low and selling high. So again, it's just predicting the future based upon past movement. Again, the first time you see a big piece of news come into the markets, you will look for a very telltale candle, and that first 1, 3, or 5 minute candle will just move in one direction very, very quickly, and that's the market jumping on something that it knows, and then it's figuring out where the market's going to go in the future from that. And you can look anywhere between 38.2 and 50% Fibonacci, because as I've always said, if you do Fibonacci based on the high and the low of what you know, then generally that 50% will be an area of interest 80% of the time. And if it doesn't get back to that, it just makes it even more likely that we're going to see, a continuation pattern. So big green, a little bit of red consolidation, then the market goes on to make that inevitable new high. So again, it's the same slide, essentially. The kind of fundamental roundup is just, really what you're trying to do is stay in the trade for as long as you can. And that means that you'll see initial move, you'll see a pullback. And that pullback is not where you get out your profit. That's more where, again, you look to average in and put more size into a trade. Because, again, if you're looking at the technical side of trading, and it is a bigger piece of news, markets go up, pull back slightly, and then go on in the direction that they initially spiked in. That's just a continuation trade. So again, things that are going to move the markets, it's going to be things like the Fed, so anything to do with interest rates. Again, these are all, we've still got Mark Carney involved, we've still got Mario Draghi, Angela Merkel, but really it's Janet Yellen. Obviously there's a big focus on Mark Carney today and the comments he made about, the 70 billion of stimulus and cutting interest rates to historic lows. And, it's saying they've got tools to deal with the slowdown, but it's the GDP, that was kind of, cut by 1.5% post-Brexit that people are getting concerned about. And at the end of the day, it is what it is. It is what the people voted for. So there might be a short-term downturn in GDP, but it's not necessarily a bad thing. What's being hurt right now is top-end prices of luxury homes in London. Who really cares about that? The top 1%. So the rest of the people probably aren't that bothered. Other things that move the market is non-farm payroll, which we're going to have tomorrow. So that's the employment situation in the US. So a very big piece of data. Then we've got things like the GDP, which we've seen cut heavily in the UK, but the US GDP is probably the biggest figure because it's again the world's biggest economy. Then we've got Michigan sentiment, the trade, interest rates, trade deficits. And these kind of things, again, are going to affect every market. Big enough data over the US will affect every market, from currencies, to commodities, to the indices. So again, always look for what happened in the past, happened in the future. So again, we can just draw a basic line of supports. When we were having news that supports the trend in the market, every time it goes down, what happened in the past, will happen in the future. So again, these low areas, that people found value in previously in the chart, we'll find them again in the future. So always look on the right kind of time frames. If you're doing your technical, look at your higher time frames. So this is a daily trend that we can draw through. So we're looking at the hourly charts. We see the market again, breaking down, but we know that in the long term, that's going to be a good place to buy. So if we don't buy high, we buy low. When we buy low, we then expect the market to carry on in the way it went in previous higher time frame directions. So again, it's all about the bigger picture, isn't it? Looking where the market's been in the past, using these, as ways to trade in the future, and these dotted lines that you draw on the dailies that are good support. Again, you just put them onto your hourly chart, and then just carry on trading from the bigger picture. And then again, it's using the averaging to kind of find out where that is. So again, all the way down here, this is where you average into this section of time, because historically this is a good level to buy. So as the market dips down, every time it's red, you buy some. So instead of buying your entire position here, you buy 2 lots here, 2 lots here, 2 lots here. And as the market then goes up, gets back down, then it continues. So you have to be patient. You have to wait for these things. But it's looking at long-term levels for short-term trades. So again, it's using hourly and daily targets combined. So you know where it's been in the past. So when it breaks through, again, these are higher time frame levels. On the shorter time frames, it goes down. That's great. You average into these low positions, and you wait for the market to get back to where it's been in the past. So you have targets, to get in, and also targets to get out. And that's what traders generally, miss. They don't stay in the trades for long enough. If you've bought at the absolute low of the market and averaged in here, then all you have to do is wait for it to hit previous levels that we've seen in the past. And that, again, gives you defined targets. So really the strategy when you're trading markets is that you shouldn't put all your eggs in one basket. So if you've got margin to use, 50 DAX, and you can trade 50 DAX, you don't just buy 50 DAX at one price and put a 10 tick stop in. What you could do is buy 20 DAX, at 5, clips. So buy 5 here, buy 5 here, buy 5 here, and build up a position to get rid of that, that noise, that problem with, markets jumping up and down. And then, again, giving yourself a little bit more time to breathe in the markets, and then as the trade goes on in your favor, you've then got the option to scale out as well, so take profit when it's on the table. So really what you're always doing is looking at the higher time frames, the weekly, daily, hourly. Then you zoom into your 5 minutes, 15-minute charts to then use those levels, where the market's been in the past, as entry points and also exit points for the future. So really that's a rough guide to averaging, not putting all your eggs in one basket, letting the market come to you, and then trading, not with defined fixed stops, but putting smaller positions, through time into bigger positions to then hold on to get rid of that volatility. Any thoughts, any questions, anything you'd like to ask? I mean, we've got the live non-fan payroll tomorrow from 1 o'clock onwards, so everything that I've just said today, I'll show you in live, real time with the real money tomorrow. That's an easier way, to do it by example. This is just a kind of theory behind it. Anything you would like to ask, guys? Anything? I mean, again, I was going to go through the effect on the markets today of the interest rate cut, but it's pretty easy for everyone to see, really. Demand for pound went down because obviously savers pull money out because they don't want to, they get less return, and then the global demand for the pound. But I mean, the pound's always going to bounce back because long term, where are the 1% going to put the money? Where are the kind of who's safe in the world right now? You're going to put lots of money in the renminbi, you're going to put it in the yen. The UK, still the fifth biggest economy on earth, so we will see a demand for the pound in the short term go down, but it will obviously come back because the UK is still historically a very safe place, to kind of put large sums of money. Nothing else, guys. Like I said, just join me, for the non-fan payroll tomorrow. Probably a lot more interesting than listening to the kind of same old stuff that I've been kind of just bringing to you over the last kind of few months. So I'm writing some new material, so there will be, a new course that's going to be released in the next kind of couple of weeks. So new interesting things. But the idea behind averages is a pretty simple one, to be honest. Don't just buy all your leverage with one position and a stop. Build into positions. Okay, I mean, platform-wise, I would generally say MT4 because MT4 is a lot more versatile. You can actually trade through your charts. If you're a beginner trader, maybe it's an idea to use the web-based platform because there's a lot more things you can trade. So I would say, if you want to be an individual CFD trader and trade individual stocks, then the web-based platform is certainly the best. If you want to trade the main indices, gold, FX, and you want to trade in a more technical manner through your charts, I'd say MT4 is best. So it really depends on the products. If you want to trade more products, trade the web. Less products, then you want to trade in the MT4. Anything else, guys? Anything you'd like to ask? Again, I'll be trading through MT4 tomorrow, so I'll be able to show you in actual, real terms, what we do, what you'll be able to gain from the MT4 platform. Alright guys, well my email address is sroughly@tradermaker.com, so if you've got any, I'll put that up. If you've got any questions, just ask me directly. That's probably the easiest thing to do, rather than just, writing things over chat. Currencies are better to trade an MT4 on iPad. I mean, the problem with MT4 is it's Windows-based, to be honest, so it's very difficult to... Well, I mean, saying that, I mean, you can trade on the mobile app on InterTrader. So I would say it depends if you're a more technical trader. This is a difficult thing for me to answer. But I would say if you want to just sit there trading currencies on your iPad or your phone, then MT4 is probably, I would say, the best thing to do. If you want to trade more individual shares like your Apples, Google, etc., then I'd probably say the web-based platform. But for trading currencies, my personal opinion is MT4 is better on devices, that's for sure. And again, the MT4 is a lot more technical trading. You can use different software packages. You can use different, kind of automated, tools, etc., etc. MT4 is a lot more versatile for your trading than the more web-based platform is what you see is what you get type thing. You can customize MT4 a lot. All right, guys. Well, if you want me to go through MT4 with you, Sylvian, just send me an email. We can work something out, and I can show you MT4 in action. It's it's what I use to trade. All right, guys. Well, listen. Anything else? Then just give me an email, the email on the chat window there, or you can get me on Twitter at Steve Ruffley. All right. It's been a pleasure. Anything else you want, guys? You know how to get hold of me. All right. Hopefully, see you tomorrow at 1 o'clock for the live non-farm payroll. Okay, guys. Take it easy. Thank you.